Every oil crisis looks different on the surface. One begins with war, another starts with an embargo, another arrives after a revolution, a shipping disruption, a sanctions regime, or a sudden recovery in global demand. The headlines always change, the villains change, the geography changes, the politics change. But beneath all of that noise, the same economic rule keeps reappearing. That rule is simple. When oil demand is hard to reduce quickly, and oil supply is hard to increase quickly, even a small disruption can cause a very large price spike. That is the rule behind every oil crisis. To understand why, we have to stop thinking about oil as just another commodity. Oil is not like a seasonal crop that can be planted more aggressively next month. It is not like consumer electronics, where manufacturers can ramp up output in a relatively flexible system. Oil sits inside a giant physical network made of wells, pipelines, ports, tankers, refineries, storage terminals, and engines that were all built around one assumption: the system must keep flowing. The modern world does not merely use oil, it is organized around oil. Trucks move goods with it, ships burn it, planes depend on it, factories use products derived from it, agriculture depends on fuel and petrochemicals. Entire suburban transportation systems were built on the expectation that gasoline would remain available every day, at every corner, in every country that can afford it. That creates a special kind of market. In the short term, consumers cannot easily stop using oil. If gasoline prices jump tomorrow, most people do not replace their car next week. Airlines do not redesign their fleets in a month. Freight companies do not rebuild logistics networks overnight. Demand bends, but slowly. Supply is just as stubborn. If a major producer loses output, the world cannot simply drill a replacement field in 2 weeks. New oil projects take years. Refineries are specialized. Shipping routes are limited. Spare production capacity is rare, expensive to maintain, and concentrated in only a few places. Now put those two facts together. Demand cannot fall fast. Supply cannot rise fast. That means the balancing force is price. And when the market is already tight, price does not move gently. It jumps. This is why oil crises often seem irrational at first glance. People hear that a disruption removed only a small percentage of global supply, and they wonder why prices reacted so violently. But the answer is that the oil market does not need a huge shortage to panic. It only needs a shortage at the wrong moment, when every barrel is already spoken for, spare capacity is limited, inventories feel thin, and nobody is sure how long the disruption will last. Oil prices are not just numbers, they are signals in a global auction. They tell the world who gets the next barrel and who does not. When supply is abundant, the auction is calm. When supply is tight, bidders start to outbid one another aggressively, because the cost of not getting the barrel may be even higher. That is when an oil market turns from stable to explosive. And this is the first big idea to remember. Oil crises are not only about lost supply, they are about lost flexibility. A market with plenty of spare capacity can absorb shocks. A market with little spare capacity cannot. A market with full storage tanks can stay calm. A market already running close to its limits becomes fragile. The same disruption that would be manageable in one year becomes a crisis in another. So when people ask why oil crises keep happening, the answer is not simply that the world is unlucky, or that politics are unusually chaotic, or that traders are emotional. The deeper answer is structural. Oil is a market where both buyers and producers are slow to adjust in the short run, and when both sides are slow, price has to do all the work. That is the economic rule behind every oil crisis. Once you see it, the history of oil starts to look less like a series of unrelated disasters and more like the same mechanism repeating itself under different names.
Take 1973. The story is often told as a political shock, and of course it was. The Arab oil embargo turned energy into a weapon and stunned the industrial world. But the real damage did not come only from the political decision itself. It came from the fact that oil-consuming economies had almost no ability to adjust quickly. Their transportation systems, industries, and households were deeply dependent on petroleum. Once supply tightened, prices had to rise hard enough to force behavior changes that technology and infrastructure could not deliver quickly. Then came the Iranian Revolution at the end of the decade. Again, the immediate cause was political upheaval, but the deeper pattern was the same. A supply disruption hit a world that still had rigid demand and limited short-term alternatives. Fear amplified the shortage, inventories became more valuable, and the market priced not only the oil that was missing, but also the risk that even more oil might disappear. That risk premium matters. Oil crises are never priced only on current barrels. They are priced on expected barrels. If traders believe a disruption might spread, the price responds before the full physical loss even appears. In oil, uncertainty itself becomes part of the shortage. The Iran-Iraq War repeated the logic. The Gulf War repeated the logic. Different battlefield, same mechanism. A disruption in a strategically important region triggered a price response far greater than the raw volume numbers might suggest, because the market was not evaluating a spreadsheet in isolation. It was evaluating the possibility of cascading losses in a system with limited slack. Then look at 2007 and 2008, because that episode teaches an equally important lesson. Not every oil crisis begins with barrels physically knocked offline. Sometimes the crisis comes from demand growing into the ceiling of production capacity. That period was not driven primarily by one spectacular supply interruption. It was driven by a world economy expanding strongly, especially in emerging markets, while production growth struggled to keep up. In other words, the crisis came from tightness. The market kept asking for more oil, but the system could not answer comfortably. Once that happens, even a small disturbance becomes powerful because the cushion is already gone. This is the oil market's hidden law. Crises happen not only when supply falls sharply, but also when spare capacity falls quietly. A lot of people miss that because spare capacity is invisible. You can see a war on television. You can see ships blocked in a narrow waterway. You can see sanctions announced at a press conference. But you cannot easily see the absence of backup supply. And yet that absence may be the most important fact in the entire market. Think of it like electricity in a city during a heat wave. The blackout is not caused only by one damaged cable. It happens because the whole grid was already under strain. In the same way, the oil market becomes dangerous when global demand is pressing near the system's productive limit, and the remaining buffer is too small to reassure everyone. This is why some geopolitical events cause only modest price movements, while others trigger panic. The event alone is never the full explanation. You also have to ask, how tight was the market before the event? How much spare production could come online quickly? How much oil was in storage? How confident were traders that other producers could compensate? How long did they expect the disruption to last? Those questions determine whether an incident remains a headline or becomes a crisis. And this helps explain a second misunderstanding. People often believe oil crises are caused by greed, speculation, or market psychology alone. But speculation does not create the underlying fragility. It reacts to fragility. Traders may amplify moves, but they do not invent the physical and economic conditions that make amplification possible in the first place. If a market is well supplied, fear has limits. If a market is thinly buffered, fear becomes expensive. That is why oil history feels repetitive. Every decade has its own cast of characters, but the script underneath is familiar. A tight market meets a disruption. Consumers cannot quickly reduce use. Producers cannot quickly replace lost output. Uncertainty raises the value of inventories. Futures markets pull risk into present prices. And the world suddenly remembers how dependent it still is on one commodity. The oil crisis, then, is not just an event. It is a stress test. It reveals how little room for error the system really had.
So let's go deeper into the mechanism itself. Why is oil so vulnerable to dramatic price spikes compared with what looks like relatively small changes in supply and demand? The answer begins with short-run inelasticity. That word sounds technical, but the idea is intuitive. Inelastic demand means people do not reduce consumption very much when prices rise, at least not immediately. Inelastic supply means producers do not increase production very much when prices rise, at least not immediately. Oil has both. If commuters must drive to work, a sudden jump in gasoline prices does not erase that need. If airlines have scheduled thousands of flights, they cannot suddenly stop buying jet fuel because it became expensive. If goods still need to move through ports, highways, and warehouses, diesel demand does not disappear just because fuel costs more. On the producer side, things are no easier. Oil production is bound by geology, equipment, maintenance, labor, logistics, and political constraints. A producer cannot just press a button and flood the market with perfect replacement barrels. Even when output can rise, not every barrel is equally useful. Refiners are configured for particular crude slates. Transport routes matter, timing matters, quality matters. So when the market loses even a modest amount of supply, the adjustment cannot come from immediate abundance. It comes from rationing, and rationing in a global market happens through price. Higher prices force painful decisions. Some consumers cut travel. Some firms pass costs to customers. Some factories reduce output. Some households cancel spending elsewhere. The barrel goes to whoever can still afford it most. That is why oil shocks spread through the whole economy. Oil is not only an energy input, it is also a cost transmitter. It raises transportation costs, manufacturing costs, food costs, heating costs, and inflation expectations. It works like a tax that no parliament voted for, but everyone pays. This is also where spare capacity becomes crucial. Spare capacity is not just extra oil in some abstract sense. It is emergency flexibility. It is the difference between a market that says, we can cover this, and a market that says, we hope this does not get worse. When spare capacity is high, a disruption is less frightening because traders believe replacement barrels can arrive. When spare capacity is low, every disruption becomes more threatening because there is no obvious backup plan. The market starts to price vulnerability itself. Inventories play a similar role. Stored oil is a buffer against immediate scarcity. But if inventories are already low, or if participants fear they will need those stocks later, the current barrel becomes even more valuable. Suddenly the question is not only how much oil exists in the world, the question is how much oil is available now, in the right place, in the right form, with enough confidence behind it. Confidence is central. Oil markets respond to both physics and belief. If market participants trust that a disruption will be short and manageable, prices may rise only moderately. If they believe it could expand, or that political leaders will mishandle the response, or that replacement supply is uncertain, prices can move far beyond the size of the initial loss. This is why futures markets matter so much. They are not just side casinos attached to the real market. They are part of how the market processes information about future scarcity. A barrel next month, or 3 months from now, may suddenly seem much more precious if traders expect inventories to shrink or supply risks to intensify. Now add one more ingredient: underinvestment. Oil is notorious for boom and bust investment cycles. When prices are high, companies invest heavily. When prices crash, investment gets cut, projects are delayed, and exploration slows. But those cuts do not hurt supply immediately. They hurt supply years later. So one of the seeds of the next oil crisis is often planted during the last oil downturn. That makes the market even more vulnerable. If years of weak investment reduce future capacity growth, then a strong demand recovery can collide with a tighter system than most people expected. Once again, the visible crisis may seem sudden, but the economic setup was building quietly in the background. And this brings us to the most important insight of all. An oil crisis is usually not the result of one single bad event. It is the result of a bad event meeting a market that has lost resilience. That resilience can disappear for many reasons. Demand can recover faster than supply. Producers can keep output disciplined. Investment can lag. Refineries can be constrained. Sanctions can remove flexibility. Shipping routes can become riskier. Inventories can shrink. Spare capacity can narrow. Each factor alone may look manageable. Together, they create a market where one shock feels like many.
So the next time oil surges after a war, a shipping disruption, or a diplomatic breakdown, the right question is not simply what happened. The deeper question is, why was the market unable to absorb it? That is the real anatomy of an oil crisis. It is not just a story of geopolitics. It is a story of bottlenecks, rigid habits, delayed investment, concentrated spare capacity, inventory psychology, and a system that cannot adapt quickly enough when stress arrives. And because the global economy still depends so heavily on petroleum, that rule has not disappeared. The names change. The mechanism remains.
So what should we learn from all this? First, every oil crisis teaches the same humbling lesson. Dependence is easy to build and hard to unwind. Countries spend decades designing transport networks, housing patterns, freight systems, industrial processes, and military capabilities around abundant liquid fuel. Then they act surprised when the price of that fuel becomes a geopolitical and economic weapon. But the surprise is never the real surprise. The real surprise is how long societies keep believing they are less vulnerable than they are. Second, oil crises do not begin on the day prices spike. They begin years earlier, when resilience is allowed to erode. They begin when spare capacity becomes too thin, when inventories stop looking comfortable, when investment is too weak for future demand, when policymakers assume the market will somehow self-correct before stress arrives, when efficiency improvements slow, when diversification remains more slogan than strategy. Third, the most dangerous period in oil markets is often not obvious scarcity, but deceptive normality. That is when the system looks stable from the outside while becoming more brittle underneath. Prices may be calm, supplies may appear sufficient, but if the cushion has disappeared, calm is not safety, it's exposure waiting for an excuse. That is why the economic rule behind every oil crisis matters so much. It is not just a theory for analysts, it's a practical warning. When demand cannot fall quickly and supply cannot rise quickly,
the market becomes unforgiving. Small disruptions stop being small. Political risk gains economic force. Fear becomes measurable in dollars per barrel, and entire economies end up adjusting through inflation, slower growth, weaker consumer spending, and sudden pressure on governments. In that sense, an oil crisis is not simply about energy, it's about time. More specifically, it's about the time the system needs to adapt versus the time the shock gives it to react. And oil shocks usually arrive faster than adaptation. That is why they hurt. The deeper tragedy is that most public debate still focuses on the trigger instead of the structure. People ask whether one country, one leader, one cartel, one war, or one sanctions package caused the crisis. Those things matter, but they matter inside a market that was already capable of overreacting because flexibility had become scarce. The trigger lights the match. The structure decides whether the fire spreads. So if we really want to understand every oil crisis, we should stop treating them like random accidents. They are recurring failures of a system that runs too close to the edge, depends on buffers that are too small, and relies on adjustment speeds that reality does not provide. That is the rule. Not that oil is always scarce, not that politics are always irrational, not that one producer controls everything forever, but that in a tightly balanced oil market, with rigid short-run behavior on both sides, price becomes the shock absorber of last resort. And shock absorbers, by definition, take the hit. So the next oil crisis will probably arrive wearing a different costume. It may come through war, sanctions, shipping lanes, underinvestment, demand surprises, or some combination of all of them. Commentators will describe it as unprecedented. They always do. But underneath the language of novelty, the same old rule will still be there. A market with low flexibility cannot absorb stress quietly. And when that market powers the modern world, every barrel becomes political, every shortage becomes financial, and every crisis becomes a reminder that economics is often most brutal where adaptation is slowest.